Welcome to the Deep Dive. Today we're getting into something really interesting, maybe a bit unexpected, connected to something you probably remember from President Trump's trade tariffs.
Right.
Forget the idea they were just random, impulsive moves. Our sources today suggest there might be a much bigger picture, maybe even a deliberate strategy to reshape the whole global economic system.
That's the angle, yeah. And for you listening who wants to understand these big, complex global trends without wading through dense economic texts, we're going to try and unpack a view that really challenges the standard narrative. The material we're looking at suggests these tariffs weren't just, reactions, but maybe calculated first steps in a much larger plan.
Exactly. And look, we're not saying this is what happened definitively, but it's a fascinating way to look back at those events. So the big question we're exploring today is, could those tariffs have been the opening salvo in a plan to fundamentally change the world's economic order?
A pretty radical idea.
It is. Okay, so let's dive in. What's the basic argument for this hidden logic behind the tariffs?
Well, the core idea presented in our sources is that the tariffs were intended as a kind of shock therapy.
Shock therapy.
Yeah. The aim wasn't just about fixing specific trade deficits here and there, but to really shake up the established system of global trade, to force everyone, basically, to rethink the deals and relationships they had.
Which feels so different from how it seemed at the time, doesn't it? I mean, most people probably remember the 2018 tariffs on China.
Oh, absolutely.
And the immediate fallout was just, retaliation, right? Tariffs flying back and forth, businesses scrambling. It seemed pretty chaotic.
It definitely looked chaotic on the surface. But this perspective we're examining argues the ambition was potentially much wider than just, say, targeting China or another specific country.
Okay.
The idea is that by using the threat of tariffs, and sometimes the reality of them, across the board, the goal was to proactively force a massive renegotiation of global trade rules, to get everyone back to the table, essentially.
So less reactive, more strategic disruption. One of our sources used a neat analogy for this, like playing chess, thinking several moves ahead, instead of just playing checkers, reacting to the last move.
That's a good way to put it. Chess, not checkers. And this connects directly to what the source material calls a potential Mar-a-Lago Accord.
Okay, Mar-a-Lago Accord. Now that sounds intriguing. It's not an actual treaty, right?
No, nothing official like that. It's more like a conceptual label for the kind of new world order this tariff strategy might have been aiming for, a possible end state.
And the key feature of this potential accord is a tiered system, like not everyone playing by the same rules anymore.
Exactly. That's the core concept. You'd have, say, a tier one. These would be countries really closely aligned with U.S. interests, strategically, politically.
Like close allies.
Right. Maybe think Canada, the UK, Australia, countries like that. They might get very low tariffs, maybe even zero tariffs. And these economic perks could be explicitly linked to security partnerships.
Okay.
Then you'd have a tier two. These countries might face higher trade barriers, maybe significant tariffs. The pressure would be on them to, change their alignment or policies to try and get into that better tier one.
So it's using trade access as leverage for broader goals.
Precisely. It's economic leverage tied to geopolitical alignment. Not just about dollars and cents, but about strategic positioning.
It sounds like building a whole new economic club, maybe with VIP levels. The source even mentioned a comparison, Bretton Woods 2.0. Now, maybe just quickly for listeners, the original Bretton Woods set up the post-WWII financial system, dollar tied to gold.
Right. It established a stable, predictable order for decades.
So what's the 2.0 twist here?
Well, the key difference in this potential 2.0 vision is moving away from gold entirely. Instead of gold backing the system, the leverage becomes, access to the U.S. market, those security guarantees we talked about. Influence and alignment become the new backing, in a sense.
Interesting. Okay, now a really critical piece of this puzzle has to be the U.S. dollar itself. What happens to it in this scenario? The argument isn't that it disappears, right?
No, not at all. The dollar remains central. But the sources suggest it might be managed towards a deliberately somewhat weaker state.
Weaker? Why would they want a weaker dollar? Usually you hear about wanting a strong dollar.
Well, the strategic thinking is twofold. First, a softer dollar makes American-made goods cheaper for other countries to buy.
Boosting exports.
Exactly. It acts like an automatic price cut on made-in-the-USA products globally.
Yeah.
That could really help domestic manufacturing.
Okay, that makes sense. What's the second part?
The second part is that even with a weaker value, the dollar's fundamental role as the world's main reserve currency the currency everyone uses for big international deals, for oil, for central bank reserves. So that role is so entrenched, there would likely still be huge global demand for dollars anyway.
But hang on, doesn't a weaker dollar usually mean inflation? That's the big fear, right? Imports get more expensive. Some of us remember the 70s, stagflation. Wasn't a weak dollar part of that problem?
That's a very real risk, and the sources we looked at absolutely acknowledge it. A weaker dollar can push up the cost of imported goods.
So how does this strategy account for that?
The counterargument proposed is that this would happen alongside a major push for reindustrialization within the U.S.
The Make America Make Again theme.
Precisely. If tariffs and a weaker dollar encourage companies to bring manufacturing back to the U.S., you create domestic jobs, you produce more goods at home.
And rely less on those suddenly more expensive imports.
That's the idea. More domestic production could, in theory, offset some of those inflationary pressures from the weaker dollar and the tariffs themselves.
So it's all interconnected. The tariffs, the weaker dollar, the push for domestic manufacturing. It's not just about trade deals in isolation.
Not according to this perspective, no. It links directly to national security, too. Well, think about the supply chain vulnerabilities that became so obvious during the pandemic.
Oh, absolutely. Masks, medical equipment, even computer chips. We suddenly realized how much we relied on just a few places overseas.
Exactly. So this push to revive domestic manufacturing, spurred by tariffs, isn't just about jobs numbers. It's seen as crucial for strategic autonomy. The sources specifically point to sectors like semiconductors, chips, pharmaceuticals, steel.
Key industries.
Key industries where relying too heavily on foreign, potentially rival nations is seen as a major national security risk.
Okay, I can see the logic there, but let's be practical. This kind of big industrial shift, it takes time, right? And money. And who pays in the meantime? Tariffs often mean higher prices for consumers, don't they?
That's the tough part, and it's a valid criticism. The sources acknowledge there would likely be short-term economic pain. Consumers might pay more for certain goods. Businesses might face disruption.
That's a hard sell.
It is. The argument presented back is that this short-term cost is necessary to avoid a much bigger long-term vulnerability. The idea is that dependency on foreign supply chains, especially with China expanding its influence through initiatives like the Belt and Road.
Giving them leverage.
Exactly. That long-term dependency is viewed as a greater threat than the short-term pain of tariffs and restructuring. It's framed as a pay now or pay more later kind of calculation.
Okay, let's circle back to the dollar for a second. If the U.S. is pursuing this path, potentially with a weaker dollar, even within this Mar-a-Lago Accord framework, wouldn't that just encourage other countries to finally make a serious move towards alternatives? Like the Chinese yuan or maybe the euro?
You'd think so, wouldn't you? It seems logical. But the source material really emphasizes the power of inertia in the global financial system.
Inertia, meaning?
Meaning the dollar is just so deeply, fundamentally baked into everything. Global trade contracts, international debt, central bank reserves. Switching away from the dollar is a massive, complex undertaking for the whole world. It's not like flipping a switch.
It's the default setting for the global economy.
Pretty much. And this is where the potential carrot and stick approach comes back in to keep countries using the dollar, even within this new tiered system.
Okay, so we know the tariffs are the stick. What's the carrot?
The carrot is continued, perhaps even preferential, access to the huge U.S. consumer market for those in Tier 1. It's also those security alliances we mentioned, maybe even access to American technology or investment.
So you play by the new rules, you stay aligned, you stick with the dollar system, and you get benefits. You don't. You face the stick of tariffs and potentially other pressures.
That seems to be the underlying logic presented. It's using a mix of economic incentives and disincentives to maintain the dollar's centrality and U.S. influence within this redesigned structure.
Right. But how feasible is implementing something this radical? We still have the World Trade Organization, the WTO, with all its rules about non-discrimination and predictable tariffs. How does this vision square with that?
That's a major hurdle, no doubt. The sources suggest one possible route around WTO rules could be invoking national security exemptions much more broadly.
The national security clause. That's often seen as controversial, isn't it? A potential loophole.
Very controversial. Using it widely to justify broad tariffs across many sectors would almost certainly trigger legal challenges and intense diplomatic blowback. It would be seen by many as undermining the entire rules-based trading system.
And wouldn't allies push back hard? We've already seen friction, even with close partners. Our sources mention things like the EU's digital taxes targeting U.S. tech firms or India raising tariffs on some U.S. goods. They aren't just rolling over.
Absolutely not. Resistance from allies, let alone adversaries, is a huge potential stumbling block. They have their own interests, their own industries to protect.
So how does the strategy account for that resistance?
Well, one interpretation presented in the material is that creating this friction, this uncertainty, is actually part of the tactic. The idea is that by shaking everything up, by making the future of trade rules uncertain, you force countries to negotiate. You create a situation where everyone feels they need to engage with the U.S. to figure out where they stand in this potential new order.
So generate some chaos to force new deals.
Perhaps. And the implication might be that those countries who engage early, who are willing to negotiate within this new framework, might get better terms, might secure their place in that favored tier one.
But the risk seems enormous. What if it doesn't lead to a new U.S.-led order, but just chaos? What if the whole global economy just fractures into hostile trading blocs?
That is the nightmare scenario, and the sources acknowledge it as a very real possibility. Instead of a renegotiated global system centered around the U.S., you could end up with, say, a U.S. bloc, a China-led bloc, maybe a European bloc, all with high barriers between them. More fragmentation, less global trade, potentially less stability.
A much messier, maybe poorer world.
Potentially. The perspective we're exploring, however, frames this as a calculated risk. It views the potential fracturing not necessarily as a failure, but maybe as an acceptable, even intended step towards a truly multipolar world, one where the U.S. isn't the sole superpower setting all the rules, but aims to be the leader of the most powerful bloc by strategic design.
Wow. Okay, so let's try and wrap this up. The core idea we've unpacked today, drawing from our sources, is that maybe, just maybe, former President Trump's tariffs weren't simply random or purely protectionist in the old sense.
Right. The argument is they could be seen as the first phase of a much larger, very ambitious, and definitely controversial strategy.
A strategy aimed at fundamentally reshaping the global economic order through this tiered Mar-a-Lago Accord concept, using trade leverage for strategic alignment.
And involving a recalibrated role for the U.S. dollar, weaker, perhaps, but still central, supported by domestic reindustrialization and national security concerns.
But we absolutely have to stress the massive uncertainties and risks involved, this kind of disruption. It goes against a lot of the post-war consensus on global trade.
Absolutely. History has plenty of cautionary tales about protectionism and trade wars. The potential for negative unintended consequences is huge.
So it leaves us, and you listening, with a really fundamental question to think about. Does this view represent a coherent, albeit high-risk, grand strategy for restructuring the global economy to secure U.S. leadership in a changing world?
Or is it more of a chaotic, impulsive gamble that risks shattering the global economic system with unpredictable and potentially very damaging results for everyone?
There are no easy answers there. It's definitely something that requires ongoing attention as these global economic and geopolitical shifts continue to unfold. Thanks for taking the deep dive with us today.